The US stock market as a whole is more than 60% overvalued and is reaching levels that we've only seen one time in recorded history. In this video, we're gonna dive into this chart. I'm gonna explain to you exactly what it's measuring, why it's important, and what it means for the future of your stock market investments. Coming up. Hey there, welcome. It's good to see you. If this is our first time meeting, my name is Steven Spicer, and it's my goal to help you build your rapidly growing, highly diversified net worth one video at a time. And this video in particular is part of a larger mini-series devoted to analyzing and really understanding the many signs of an imminent crash, and then ultimately using that knowledge to help you prepare your portfolio, crash or no. To start from the beginning of this series, click on the link right at the top of the description below and stick around until the end. I've created a resource for you that will help you crash-proof your portfolio. So the chart you saw earlier is tracking the Q ratio of the S&P 500. Now, if you already know what a Q ratio is, you're welcome to go down to the description right now and find the timestamps to jump ahead of this explanation. The Q ratio was developed by Nobel laureate James Tobin. It can be used to estimate the fair value of an individual stock or markets on the whole. It's a pretty simple, logical concept, but can be difficult to calculate for entire markets. For an individual company, the Q ratio is the company's total price or market capitalization divided by its replacement cost. In other words, its net worth, its assets minus its liabilities, what it would cost you to simply replace the business. Logically, you might think that a 1-to-1 ratio would constitute a fair value. For example, if you had a company with a $100 million market cap and it would cost $100 million to replace or to start an identical company, the Q ratio for that company would be 1. If the market cap of that same company rose to $150 million, the ratio would now be 1.5 and it might be considered overvalued since in theory, you could replace it for a mere $100 million or 2/3 its current price. On the other hand, if the market cap were to drop to 50 million, the stock might be considered undervalued as it would cost twice as much to replace it. I hope that makes sense. If you now have a better understanding of what the Q ratio is and how to use it, let me know by clicking the like button. I really do appreciate it. Now, you can take that concept that we just applied to one company and apply it to an entire market. And as I said, that's exactly what this chart is, the Q ratio of the S&P 500 since 1900. So today, if you were to buy into the S&P 500 as a whole through an ETF, for example, an extremely common practice without any additional consideration whatsoever. For every $1 trillion of net worth, what you could essentially pay to replace the companies, for every $1 trillion, you're paying $1.17 trillion. That's essentially what our current 1.17 Q ratio is telling us. Now, even though a 1-to-1 ratio may seem like a fair value, historically, that's not the case. Since 1900, the average Q ratio is about 0.69. That means that right now, the market is 69% above that historical mean, a level that has only been surpassed one time in history, immediately preceding the tech bubble. Let's run through some data-driven hypotheticals. If the Q ratio were to revert back to that historical mean from today's price, that would constitute a more than 40% decline in the overarching value of the S&P 500. A correction to the post-2008 low would mean a 54% drop. And just for fun, a return to the 1982 historical low of 0.28 would result in a cataclysmic 76% crash. And I always like to note that just because that's the historical low, that by no means guarantees that that's the lowest it could possibly go. Only time can tell us that. Now, of course, periods of overvaluation can last for years. So the takeaway here should not be to sell out of all your stocks and definitely not to short the market. This is a long-term indicator. You just shouldn't be surprised when the market finally does correct in the relatively near future. Also, if this were an isolated indicator, If this were the only sign of a coming crash, I wouldn't give it near as much credence, but it's not. There are so many more alarm bells going off that you should at least be aware of, and that's the whole point of this mini-series. So don't forget to click the link in the description to see the whole picture and learn how you can prepare your portfolio, whether the crash comes 5 days from now or 5 years from now. That's my ultimate goal with this, to help you crash-proof your assets, your life savings. In fact, I created a crash-proof resource guide and checklist that you can download at crashproofguide.com. It'll be a living, growing resource that you can keep coming back to as you continue to strengthen different areas of your portfolio and as we continue to find more resources to help you along the way. Again, go to crashproofguide.com if you're interested and haven't gotten yours already. Now, I have an honest question for you. It's probably too complex to ask here on YouTube, but I want you to really think about this. If you were looking for a company to buy today, like an actual company, the whole thing, not just one share, as a ratio of replacement cost, like the Q ratio, what is the max that you'd be willing to pay for a company and still feel like you got a good deal? Would you be willing to pay more than that 1-to-1 ratio? Or would you need some sort of discount to feel like you got a good deal? Let's talk about it in the comments. And if you learned something today, leave me a like, share this with some friends who could stand to benefit from this critical knowledge. Hopefully you can see the value that comes with being a member of this community. So if you haven't already, don't forget to subscribe and click the bell. I'll see you in the next video. Take care.